Hi, I'm Tom Elliott and this is another financial markets update for Hodges Real Estate. Well, these are tumultuous economic times. There's all sorts of data out there, some pointing one way, some pointing the other way. Let's get into it. Firstly, the Reserve Bank. Now, at the start of May, the Reserve Bank surprised quite a few market pundits by cutting interest rates, not by 0.25% as most people thought, but by a full 50 basis points or 0.5%. As we know, of course, the big four banks did cut their rates after this. However, they didn't pass the full rate cut on. Most of them cut between 30 and 38 basis points. In my view, the Reserve Bank knew that the big four banks, the commercial lending banks, wouldn't pass on the full rate cut. That is indeed the reason the Reserve Bank cut official rates by 50 basis points. Then of course we've had the federal budget. Now at both the state and the federal level, state being here in Victoria and the federal level, both governments, whether they be Liberal or Labor, are committed to getting the budgets back to surplus. Now usually this is a good thing and something of which most economists are in favour. I must say for myself at the moment, given the Australian economy is not doing perhaps quite as well as it could, I might have waited another year or so before committing back to a surplus. I've gone through all the figures that Wayne Swan came out with in the budget, and I've got to say I think he's being over-optimistic with growth. For example, the official rate of growth forecast for the next 12 months is 3.25%. Personally, I think that number is more likely to have a 2 rather than a 3 in front of it. So for that reason, plus the fact that I don't think the mining tax is going to raise as much money as expected, I don't think the government's forecast surplus will actually come to be. Now, what about what's happening overseas? Well, Greece at the moment is certainly the word, and not in a good way. A couple of months ago, we thought that a deal had been done in Europe, basically that investors in Greek government bonds would take a haircut on the value of their investments. The Greek government, like many other governments in Europe, would drive home an austerity package designed to reduce public outlays, increase taxes and gradually get the Greek public sector back on an even keel. Unfortunately, a little thing called politics intervened. There was an election, and if Greece cannot form a proper government, or indeed it does form a government full of extremists, there is a chance, and it's a not inconsiderable one, that Greece will reject the European bailout package that it agreed to just a couple of months ago. Well, what happens then? On a worst case scenario, Greece could actually drop out of the Eurozone. This would mean that the euro would no longer be the official currency of Greece. They'd probably have to go back to using something like the drachma. Just about every Greek bank would be instantly bankrupt and have to be bailed out by the Greek government because, of course, the European Central Bank would no longer be able to, nor indeed would it want to do it. Greece might even have to close off its own borders to stop its citizens trying to smuggle themselves and money out of the country. I don't think anybody really wants that to happen, but it is a very real possibility. Greece might only be a small country, but if it falls out of the Eurozone, then well, what other countries might fall out of the Eurozone? In our neck of the woods, I mean, we've got China, and there is some evidence the Chinese economy is slowing down. Indeed, Chinese growth forecasts were cut back from 8 to 7.5% recently. The good news is the Chinese Central Bank stands ready to cut interest rates in that country, and they can do that and get demand going again. So I'm not as concerned about China as some other people are. And also on a more positive note here in Australia, the April unemployment data came out in early May, and really in a number that surprised pretty much everybody, unemployment in Australia actually fell about 0.31% down to a very low 4.9%. Now most economists have said it's probably a statistical blip. Still, it does say that the Australian economy is trucking along pretty well. So what does all this mean for people looking to buy property, or indeed people who are already invested in the property market? Well, firstly, the all-important question of interest rates. The Reserve Bank, I think, wants to cut rates again, and if it does so, they'll cut by at least 50 basis points and possibly 75 to stave off any slowing of demand in Australia. They know if they do this, perhaps only 2/3 of the cut will be passed on by the banks, but that would mean, in line with the cut that already occurred in early May, that investors, property owners, etc., anybody with a mortgage will have found the variable rate a whole lot cheaper than what it was just a few months ago. The other issue, I guess, is what's going to happen to share markets and so forth. I think they're going to stay very, very volatile. And as a result, people who have got money to invest might say, well, you know what, the share market is now not for me. I thought we were making some gains, now they've been retraced again. You know, maybe property is looking good. As we know in Melbourne, property markets have been fairly subdued over the past few months, but there are signs that the clearance rate is starting to edge up, and that's usually good for property prices. Thanks very much for your company. I'm Tom Elliott, and this has been another financial market update for Hodges Real Estate.
Alright, I'll come with you.